Hello, good day, and welcome to today's daily educational video here at Forex.Academy. I'm your host today, Robert Blackwell, and have the pleasure to walk through today's daily education. Before we do so, please consult the following disclaimer. There is risk involved trading the financial markets. On the content of today's particular webinar, we're going to discuss trading stops. So let's get straight into the webinar itself. Okay, so trading stops. A sell trading stop order sets the stop price at a fixed amount below the market price with an attached trailing amount. Okay, so as the market moves, your stop loss effectively will move with the market. As the market price rises, the stop price rises by the trail amount, but if the stock price falls, the stop loss price doesn't change, and the market order is submitted when the stop price is hit. So effectively, your trading stop is looking to follow the market. If you're taking a long position, as the market rises, your trading stop loss will rise, continue to move up with the market in question. So if there's a pullback, you'll exit that position, likely if it continues to move to the upside for a profitable position. So you're trying to preempt that reverse and trying to grab profit when it comes to light. Let's look at how to maybe execute some of these trading implementations. So first and foremost, we have the New Zealand dollar against the US dollar. We're looking at hourly price action. What we may look to do is simply take a short position, okay? So perhaps we see this breakout here across this level. We'll simply look to only execute the trade, but we don't want a very sharp pullback this way. So we'll use a trading stop, perhaps of 15 pips. So we're going to keep our risk very tight on this trade. Perhaps we would look to simply enter here at this price. As the market trades down, we'll place a stop loss upon entry just the high of this candle, likely around here. And as the market moves down, when it's around here, it will effectively move down with it. So this will be our stop loss initially. As the market trades down, it will continue. As it trades down through these prices, it will try and just move with the market in question so that we won't actually get stopped out until we get a pullback. And again, we might get stopped out at these, but again, it's just to preempt a total move in terms of a reversal for the trade. So it is good in terms of its implementation for scalping. Again, let's look at another opportunity just in terms of its implementation. If I just take away some of our analysis here, we have yet another trade that we could look to take. Okay, now we could look to short this trade, and I'll discuss a short trade as well because there are some advantages to looking to use trading stops. That is that, well, they may actually just get you stopped out of a good trend trade to the downside. So here we have a good trend, okay? Stop losses or trading stop losses do not avoid that volatility that's inherent in Forex markets. So if we're looking to sell the market here, let's say we sell the market here at this price, okay? The market moves, our stop loss could be around here, okay? Stop loss 1. And as the market moves down again, you can see the market looks to trade. We could actually get the market trading down to these lows, but our stop loss could just move down too much. And again, if there's a quick reversal to the upside, we'll effectively get taken out of an overall trend position. So that is one downfall to using trading stops. Now, what I'd like to do is just show you this on the trading platform, of course, the JFX trading platform, in terms of its implementation as well. Okay, so the first thing, we'll look to trade just one of these markets. Again, because you're looking for a stop loss or a trading stop loss, it's more applicable to perhaps trading short-term markets. Okay, so we'll perhaps look for something with a bit of volatility in here. We can see there's moves in this market, but if we believe we've touched long-term highs in this market, say at such a price here, well, let's try and follow momentum down if we really sell the high of this market. So we're really keeping our risk very tight on the upside of this trade while looking to mitigate the risk as the market moves with us. So what we do is, first of all, we go to new order, get our new order box, of course, here. We might look to trade something with small trade size. Again, we're trading euro pound, so perhaps 5,000 euros against the pound. We'll sell that market. We're now short that price, okay? We're short that price. Now, how do we effectively look to monetize this position and follow a trading stop? Well, instead of going to modify and putting in a more general stop loss, we'll choose a trading stop here. We could set it at 20 points. So that tells us initially that all we're looking to risk on the trade is 20 pips or 20 points for this market, okay? As the market moves down, Again, as I suggested in the previous chart, if the market moves down again to profit positions, stop losses are going to continue to move down with the market to cover the position, so that effectively will mitigate the risk in the trade if the market continues with us until we get a possible pullback. Then we'll exit for the profitable position. So it can be very useful in the short term. Again, in terms of following the momentum or short-term momentum with the least amount of risk possible on the trade. Again, we've chosen 20 pips for this trade. But again, it does have one real disadvantage, that if there's some short-term volatility in the market, well, you're likely going to be stopped out as a result of that volatility and not able to expose yourself to the overall trend position. So that brings us to the end of our daily education webinar here at Forex Academy. Thank you very much for joining us. We'll see you next time. Bye for now.